How you guys doing? Do we need to like stand up and do like the stretch? Let's just do it. Come on. Don't leave me sitting here by myself. There we go. Good. Seeing yawns in the audience. We're going to wake you guys up. All right. Well, thanks everyone. I think we're towards the last one of the day. I'm not sure if there are a couple more after this, but this is going to be a fun one. All about startup metrics. Why don't we just do the quick introduction first? My name is Nathan. I run a startup called Founder Suite, which is software for raising capital. Tejo Kote, wanna?
Sure. So, name is not up here, but I'm Tejo Kote. I'm founder and CEO of Airbase, and we are an all-in-one spend management platform, right? So what that means is, if you think about all the money that companies spend, there are way too many tools used in kind of growing businesses to manage all of that, and we provide one consolidated platform to manage all of the money that a business spends.
Cool. Ryan Buckley, please.
Ryan, I'm the CEO of Mighty Signal. We track the dependencies that mobile apps have, basically the software that mobile apps install, and provide that to sales and marketing teams.
Cool. Sham.
Hi, Sham. I'm the co-founder and CEO of Punch. We are a marketing platform for traditional brick and mortar retailers. We're B2B2C. So if you've likely interacted with our software one way or the other, we have about 70 million consumers on our platform, handle or process about 1.5 billion transactions a month, close to 170 enterprise customers.
Awesome. So pretty interesting group here. Why don't we just start off with an easy one? Like, what metrics should the folks in the audience, especially in the earlier poll I did in the other room, seemed like skews pretty early stage, seed, pre-seed type of startups for the most part. Anyone here beyond like a Series A? Is everyone pretty early? Okay, yeah. So no hands. So pretty early. So let's just start off with like what metrics should startup founders be thinking about in the very earliest days, or should they even be thinking about metrics at all?
So, maybe this is a contrarian opinion, but I think in the early days, you should be very careful about going too deep into metrics, right? Because the number one question that you're trying to answer in the very early days is all about, am I building the right thing for the right customer, and am I solving a real problem, right? And so, or at least you could be metrics driven, but it should be focused on the metrics that help you answer that question. For example, you might want to speak with many customers in your target market as part of your discovery process. So a metric that you might target is all about, hey, I want to speak to at least 10 customers a month and try to be disciplined about that, right? So in the very early days, it's metrics skewing more towards gaining insights and getting to that initial product market fit. And if you have already built the product and you have the product in the customer's hands, the first 1, 2, 3, 4 customers, then maybe the metrics are a little more aligned towards value that the customer is deriving from your product. It could be, are they actually using the product? And it might differ based on exactly what problem you are solving for the customer, but the metrics definitely aren't customer acquisition cost or CAC to LTV ratio, and especially if you're in the B2B world, it's almost become a science at this point, and all these blog posts that get put out there in terms of what metrics you should track. But at least I would caution you against going too deep into that very, very early. It's simpler than that, and I would recommend that you really try to define your own metrics for the market you're in and the problem you're trying to solve, which help you get to the answer of, am I building the right product, and am I solving the right problem, and am I getting adoption for it, and then those are more important.
What's the first metric you tracked at Airbase? Because I interviewed Tejo for a podcast, and you have a pretty unusual approach to how you build Airbase. I mean, you spend a lot of time kind of in stealth mode, building this, getting feedback, iterating before you even got out there and really launched. So what was like the first metric you sort of really started tracking religiously?
So, even before I committed to building the company Airbase, I just spoke with a couple of dozen finance people, because that's the market we sell into, right? Our customer is the controller, head of finance, that's the role we sell into. And so I spent the better part of a couple of months interviewing a lot of them, because I had a thesis about what the problem was given my own experience building my previous company, but then I wanted to make sure I wasn't going to go spend the next 6, 7, 8, 9 years of my life on something that didn't really make sense to other people who were in the same space, right? And so I spent a lot of time speaking to those people, and my metrics for those first 2 or 3 months were all about how many people am I speaking with, right? And really making sure that the insights were valuable enough for me to make that decision on, okay, am I going to go build this company or not? So I started there, but then even after that, once I had the confidence that, yes, this is a real problem, and I can go spend a bunch of my years of my life going and building a company around this, then went away, built a product. I actually built a early version, just mock-ups and things like that, got a bunch of them to commit to buying it, and then started building the product, because that's a whole other conversation we can have about when you actually build stuff, right? But I still didn't launch the company for 18 months, because in our case, we sell to mid-market businesses, right? And so getting to the first 20, 25, 30 customers, you don't really have to have like a website and run demand generation campaigns and ads and things like that. If you can't get to the first, say, 10, 12 customers using your network and getting in front of people and engaging with them on your problem and convincing them to use your solution, maybe you're probably spending your time on the wrong thing, right? And so that approach worked pretty well, because I was more focused on those milestones. Am I solving the right problem for the right customer, iterating through that solution until you got to the right place, and finally, are they going to pay you for it, right? And are they going to sign up for annual deals? Just basically, methodically kind of checking off those boxes. And being public wasn't really going to help us answer any of those questions, right? And so that's basically the approach I took, and it's worked out well for us so far.
Shyam, Ryan, what were you guys thinking about in the very earliest days? Any other thoughts or feedback?
Yeah, I think what we see in terms of best metrics, like first of all, like revenue is the number one metric, right? But if you don't have revenue, then like what are you going to measure? Conversion rates are typically the thing that you should be tracking in those really early days. You're driving traffic to a landing page, maybe you're using Unbounce or your homepage. First thing that you can start to measure is how many visits, how many clicks does it take to get that user to sign up. After a while, you get enough users. How many users do you need to sign up before you can get that first customer? So we find that actually tracking conversion rates and understanding conversion rates are a good, healthy thing to begin to do right away, and you even keep doing that in later stages.
Yeah, I'll agree with everything everyone said. I think it's really important to understand what phase you're in, right? If you're just starting out, I remember when we were just starting out, it was all about getting, understanding product market fit, whether our thesis held, and whether people actually found that what we were trying to solve was an actual problem. So I remember our first 3 customers we signed for free, with the understanding that if we got them to agree that it was valuable, that it demonstrated some ROI, and that's one metric I would figure out, like what is the ROI for your customer? First of all, if you're B2B, if you're selling to customers, how are you acquiring these people, et cetera? That's even a second order question. What is the problem you're trying to solve, and how do you measure those results for these customers in your customers' eyes? And what we asked them to do was essentially run PR with us if they agreed that it was a success. So that was step one. This was before our first seed round. The seed round, I think, is about just establishing to investors that, hey, here's a general thesis. Here are 2, 3 people who have agreed that this is a problem set, and we've demonstrated that we can fix this problem for them, and you can speak with them. I think when we came to our A, it was more that we had some revenue, some people were buying our stuff, there was usage, So at that point, they'll, at least from my recollection, my A was a few years ago, but it was about proving out a little bit of the unit economics, right? So when a customer buys, are they using the product? Are they deriving value out of it? And if they are, then can we then is it backing up your central thesis, or have you learned something new in terms of that? And then post that, there are some. Then it becomes the traditional stuff you see on websites, right? LTV to CAC, magic number, sort of unit economics. How are you scaling up your teams? Blah blah blah.
Let's keep on that for a minute, so congratulations, Sham just announced a.
Well, we haven't announced yet.
You haven't
but
announced it yet.
We just closed our Series C today.
All right, let's have a little round of applause. That's
Thank you.
probably single digits, or even 1 or 2% of startups go on to raise a Series C. So that's actually huge.
Thank you.
If you put it in context, if you're willing to share, what was in your metrics in your pitch deck for your Series C? I mean, just to kind of give an example of, or some scenarios of where it goes from Series A.
So if I remember correctly, I'll just give broad stroke numbers here. We're enterprise SaaS. So these are ARRs, if you guys are familiar with this, annual recurring revenue, that's what we track. So for our Series B, we were at, I want to say around 10 million ARR, heading to a number we met. For Series C, what they actually looked at were our past projections and whether we met them. And they actually looked at our past board decks to see if we were actually fulfilling those numbers. So that was interesting. This is just FYI. Second piece is really core analysis on unit economics. So I think the type of investor at the seed stage varies from your A and B, and at C plus, it's a different type of investor. These tend to be slightly more financial focused. So they're looking at fuel money, whether you have your unit economics. And unit economics for us in our context was net retention. So they want to see if you have customers signing on, and if some customers are leaving, are you still refreshing that? Or do you have an upsell cadence? And that number, from what I've heard, the top quartile, you need to be at about 120% net retention. So meaning net of people leaving your customer base, you're still adding 20% more than on a renewal basis, right?
By upselling to the ones that remain.
Upsell, expansion, net of retention should be at 120%. That's the top quartile. Second metric is LTV to CAC. So it starts mattering at this stage, which is basically what is the cost of acquiring a customer? If it's unprofitable, then there's an issue. Third is magic number. This one is little. It just is an indication of whether you're so efficient or inefficient that you can invest more in sales and marketing. Magic number just tells you per essentially dollar you spend in sales and marketing what you're getting out in terms of additional ARR. So if that ratio in a 4-month, so it's a past quarter to this quarter over the next 4 months. So anyway, you don't need to worry about it right now, most of you. But what that says to an investor is it's an indication that you can throw fuel money on this, right? So if that ratio is sitting at over 1, then it says that for every dollar you put in, you're getting another buck back over the next 4 months in the next quarter. 4 quarters, excuse me. And so it's an indication that you should invest in sales and marketing. So it tends to be around these very sort of hard metrics. The questions they would ask in the beginning, which is, will someone use your product? Like, is this even fixing an issue? Those obviously go away. Now it's just like, are you generating money? Are people, what do they think of your product? And can we throw money at this? If we put money in, what do we think we'll get back as an exit?
Let's stick on the metrics for investors for a minute. I thought that was interesting. You made a comment that your investors were comparing to the projections you made in previous rounds. you don't, this is a public stage, you don't have to really answer this question, but did you sandbag those earlier projections so that, of course, you come in just clobbering them and blowing them out? I mean, how much gaming is there of your projections? So
Yeah, I mean, so let me kind of, so that happened during the diligence phase. When when you're first pitching, they're just looking at your projections. And they're looking for a strong pattern, right? Like we had over 100% growth for 4 years straight. So they were looking for those patterns, and then they were looking for a projection just to see if you keep those patterns. But I would say this is where there's no science, it's an art. So you just, in the beginning, I would say be aggressive, right? But you should just know anyone you pitch likely has your decks. So if you come back 6 months later, and they kind of keep you warm, it's because they want to see if you're going to actually do what you say you're going to do. So, you shouldn't be too, like, don't say you're going to hit the moon if, you're not. So you want to be somewhat realistic, but you don't want to be so realistic that people aren't excited, I guess. I don't know.
yeah.
But they will measure you. So whatever you put out there, just know there's a record. I don't know if you guys are.
And the earlier stage you are, the more leeway you'll get in terms of
Yeah.
not meeting that plan, because at the seed stage and even to an extent of the Series A, you don't know what you're going to do
Exactly.
2 months from now, let alone a year from now, right? So you can't really come up with a plan for an entire year, and the world changes, and your learning of the market changes, the learning of the customer changes, and a lot of these things evolve, and your plan for the year might change, right? You might stop in the middle of the year and say that, look, I'm going to tweak my plan, and obviously you'll get sign in from your board if you have one, and that will happen. But the later stage you are as you grow, the less leeway you will get, because the expectation is that your business will become more and more and more predictable as time goes, right? And so, the further along the journey you are, the more the expectation is that that your ability to predict goes up.
That's very true. I'll just say one thing is maybe relevant. Tejro's a serial entrepreneur. I was a first time. So maybe that's why they were measuring me more. So if you are a first time entrepreneur, just know they may actually keep those, because there's no track record, right?
Yep.
So
Just a quick time check. What time does this run till? Does anyone know? 10 minutes. Okay, perfect. Anyone measuring NPS or kind of customer satisfaction? And if so, maybe talk about it. Talk about what it is and how you use it internally. Ryan, do you want to give any comment?
No, we're not.
No, not right now.
So we are in the process of implementing it.
Okay.
So
Just define it really quickly for anyone not familiar.
Net Promoter Score, it's essentially a survey, think of it that way. But you want, there's, again, industry standards around what number you should be above. But it's just a gauge of whether your customers like your stuff or not. That's really what it is. At the beginning, honestly, you don't need it. Because if you aren't talking to your customers, there's something really wrong, right? So you should, first of all, know who your customers are and be in conversations with them. But at this stage, we have 170 customers. It's hard. Like our CS organizations alone is 50 people. So, they are on this cadence of kind of multiple touch points, when customers are up for renewal, et cetera. It's a gauge of, in SaaS, it's a predictor for if you're going to have some churn. And churn is the key thing you want to measure in a SaaS business. So.
Yeah, and absolutely right. And you might have noticed that Shyam is implementing it, at a Series C stage, right? And I completely agree with him that it doesn't really make sense in the early days because you don't have that many customers, right? If you have only a handful of customers, you have to be kind of engaging with them, speaking with them, and you will likely have a good sense for whether you're making them happy or not. The whole point of NPS is, do you have a happy customer, and are they going to recommend you to other kind of peers of theirs, and that's kind of the central thing you're trying to measure. And if you don't have that many customers, of course, that might be different if your business is one where you have many very small customers, or it's a consumer business or something like that. But and that's a whole other kind of ball game. But if you're anywhere in the B2B space, in the early days, you likely don't have many hundreds of customers that you find it hard to get that sense for are my customers happy? Am I going to lose them? Are they going to churn? And that's kind of irrelevant. But as you scale, you will have, one thing is that NPS allows you to answer the question of, are my customers happy in a more scalable way? And at the same time, you can have follow-on processes. For example, anybody who gives you a 9 or a 10 in an NPS survey, they're very happy, automatically trigger an email asking for a review on a G2 Crowd or a Capterra, because those things really matter, and you can kind of instrument all of that and kind of have a better process around it, but not in the very early days.
I think we're going to take a couple quick questions. Maybe while folks are thinking about your questions, let's just talk about, Ryan, you mentioned in the pre-warm-up you made some mistakes at Scripted around metrics. Do you have a little funny anecdote to share with us?
Yeah.
How to not do metrics, maybe?
Yeah. No, I think one of the things that we definitely could have done better at this company, and I exited it a couple years ago. We raised about $18 million and sold it for significantly less than that to a private equity firm. I think maybe the best metaphor is like this. If you can put yourself back in high school, and if you were able to, when the report cards come, when you give the report card to your parents, choose which classes you share with them and which grades you shared with them, you'd probably have like what appeared to be a really good GPA. And so semester after semester after semester, you're kind of cherry picking which classes you're reporting back to your parents, who are kind of like your board or your investors. And then when it comes time to apply to college, you don't get in, and you say like, well, GPA was actually kind of crappy. Like you had a really low GPA. And then your parents go like, why? Like you had like a 4.0, and you say, well, yeah, I didn't include every single class on my transcript. I was able to erase them, and I didn't see that F in my bio class or my D in trigonometry. In essence, that's what we and I think a lot of startups do. Every board meeting, we just essentially cherry-picked numbers. We didn't have a consistent reporting regimen, and our board really didn't require it. And it's a complete 180 now in private equity. Like good, bad, and ugly, we are reporting the exact same thing every week and every month, good or bad, and there's no getting, there's no shortcutting it. Like you have to report the same numbers all the time. And I think this is like, I've learned a lot from that. And it's just like, it's good discipline, and it's just a good hygiene for running a business.
Even with we're probably the smallest. We're a seed-funded startup, and even so, we do quarterly reporting. Every quarter, I've got to get in there, and sometimes you're wringing your head, like, oh man, this churn rate is awful. It's healthy though to kind of confront the demons and the angels, if that makes sense. Who's got a question? Let's bang out at one, or if we have time, two questions. Yes, sir, in the front row.
I really appreciate that you asked how many people are early stage. I am in early stage as well. And at the moment, I face the challenge of getting my first 10 customers. Can you give me some advice for the first 10 customers in 2019? Thank you.
No, where?
So again, my personal approach was lean on your network, right? And so, people other founders if you have investors, really lean in on their network and get in front of, if you want to get 10 customers, maybe you have to go get in front of 100 customers. And so it's think of it as a pipeline problem. And but don't get into sales mode, early on, because I did exactly what Shyam mentioned, in that a bunch of my customers, I basically told them, look, don't even pay me for the first 6 months, right? Because all I want to do is I want to learn, because I can't learn if you don't start using the product, right? And just removing that hurdle of them thinking about, oh, this is a startup, or can I pay them? What if they disappear tomorrow? And there's a social capital that they have to expend internally within the business to make that happen. Take all of that risk for them off the table. Try to find the champions who believe in your vision of the problem you're trying to solve, and make it as easy a decision for them to get going as possible with that understanding and handshake deal that, look, if I really do solve this problem for you, you will convert over to being a paying customer, and kind of that's how I would approach it.
I have two very nuts and boltsy answers for you. So between when I exited Scripted and this gig, I started several little 1K to 20K a month B2B apps. Didn't spend any Google ads, didn't spend anything on marketing. So did that by going on Quora and just dropping links to your product. Inevitably, I mean, if you're solving a large enough problem, there'll be questions asking, how do I do X, Y, and Z? And then you just go in there as yourself and say well, I actually built this thing that does X and Y or Z, and put that in there with a link to your page. People will find it over time. It'll get indexed. The other thing is Google just, whatever you think, this is sort of an SEO best practice anyway, your ideal search term. If your ideal customer was looking for your product, what would they be searching for? Throw that into Google and see what pops up. You might have to search down a little ways, but there will be blog posts about your idea, people blogging around it, about it. There are usually still, even today, comment boxes on those blog posts that you can write. A lot of them get turned off, or there'll at least be a reCAPTCHA to do bot protection. But if you authenticate, and again, just be authentic, be yourself, and write about yourself. It'll take some time, but you'll get traffic.
So
Cool. That is it. Can we have a round of applause for these guys, please?
Okay.